All right, I welcome you to this session. My belief is that you have read through the question and therefore you are in position to start. I will be referencing, of course, coming back here and then going back to our working as we pick the facts regarding the question. So before I begin, please confirm that the screen is visible from your end so that we can start. Confirm that the screen is visible so that we begin. Okay. So here we have ABC Limited, sorry, which was incorporated in Uganda and deals in the buying and selling of household items, among other businesses. The following information was extracted from the trial balance of Abc Limited for the year ended 30th of June, 2015. So we are given the trial balance, as you know. It has the debit side, a debit column, and the credit column there. And these are elements of financial statements, which I know you are aware of. So we are given additional information, which we are going to go through line by line. And also we shall be appreciating how to treat the additional information. And then down here, we are required to prepare the statement of profit or loss and other comprehensive income, together with the statement of changes in equity for Abc Limited for the period ended 30th of June, 2015. I'll be taking you through in the interest of time. Then I'll share the solution, which is also available on your student account. You can still download it, but I'll share these on the respective groups. So the best approach to this usually compulsory question number 1, is to understand the additional information. Most of the treatment or the workings will be enshrined in the additional information. So for you to manage the additional information in the exam, you prepare a schedule, which looks like this. And on this schedule, you will be showing the question number or the part of the additional information number. Then you show the applicable standard here. You show the accounting treatment, and then you give the examiner the accounting entries. Since this is our very beginning or our very first example, I'll do all the workings, interpretations, and accounting treatments. But for the subsequent ones, I'll give you try them out, and then we shall share when we meet again in a live session. So we begin with our very first note on the additional information, which is additional information number 1. In additional information number 1, we are told that Abc Limited repaid a loan of 100,000 US dollars that had been obtained from a foreign bank when the exchange rate was 2,900 Ugandan shillings to $1. The loan had been booked at the rate ruling on the date of acquisition. The exchange rate at the date of settlement when we cleared the loan was 3,450 to $1 US. Now, as you can see, there is a difference between the exchange rate on the transaction date, on the date we booked the transaction, and the exchange rate when we repaid our loan. Definitely, this is going to bring in an exchange difference, and also it's going to require us to follow the requirements of IAS 21. IAS 21 is the one that handles these foreign exchange or transactions denominated in foreign currency. So as my very number 1, I come and show the examiner that in my additional information number 1, I'm dealing with IAS 21, which is, I mentioned the name of the standard, effects of changes in foreign exchange rates. Remember, in our examination review, final examination review, I mentioned that the examiner has called upon the candidates to mention the name of the standard and also the code of the standard. So it is very, very important that if you are to use IAS 21, indicate that I'm using IAS 21, which is this and this and that. In this case, effects of changes in foreign exchange rates. So our very first transaction, or transaction number 1, is settlement of a foreign denominated loan. So what does the standard require if a transaction is denominated in a foreign currency? IAS 21 requires that when cash settlement occurs for foreign denominated transactions, the settlement amount should be translated into the functional currency using the spot exchange rate at the settlement date. So this is how you do it before you apply the standard. Mention the provision or the requirement of the standard that you're going to base on in determining your values to be taken to the financial statements. So according to IAS 21, if you can recall what we discussed, if you have a transaction that is in a foreign currency, you'll be required to translate it into your functional currency. In this case, the company Abc Ltd, its functional currency is a United States dollar. So we need to translate, okay, that amount into the Uganda shillings. And now that the amount differs from that used when the transaction occurred, there will be an exchange difference. And according to this difference on settlement of individual transactions must be recorded in P&L in the period in which they arise. So we shall determine the settlement amount by getting the United States dollars 100,000 times our rate at the date when we settled the loan. The acquisition date amount, on the other hand, is the same amount, the USD 100,000 times 2,900. So you see that by the time we are settling the loan, the amount is 345 million. Yet at the date when we got the loan, the amount was 290. That leads us into an exchange difference, which is a loss of 55 million. You can see how things can be bad. That a loan of 290 is now at 345. The loan was at that we obtained as 290 is now at 345. So after, of course, doing all this, you go ahead to give the accounting entries. You go ahead to give the accounting entries, and there are going to be 2. Our journal entry number 1 is to debit the loan account with 345 and credit our bank account because we are settling this loan 345. So in this case, we're recognizing the loan repayment. And then because of the exchange difference, we shall pass our second journal entry, which I'm going to put in red here. So because of the exchange difference, we shall debit P&L, it is an exchange loss, and then we credit our loan account with 55 million. Our loan has increased by 55 million because of the exchange or movement in the exchange rate. So that is our transaction number 1. I'll give you some 5 minutes to look at it And if you're satisfied, if everything is okay and you have no question, type in the chat, continue, so that we can proceed. Okay, so that is our number one. Next, we move to the second one. So in the second point here, additional information, piece of information, we're told that included in the revaluation reserve is a revaluation gain of 18 million for an asset that had been revalued on 30th of June 2014 and was disposed of on 31st of December 2014. So let us see. Revaluation reserve is right here. Within this figure, there is an asset that was disposed of. So what does it mean? It means that this revaluation must be adjusted to reflect the transaction disposal. So I go back to my schedule here, and transaction, I earmark my transaction number 2, and the relevant standard is IAS 16, property, plant and equipment. And the transaction is disposal of an asset with revaluation surplus. I give an indication of the accounting treatment, and here we are saying, according to IAS 16, when an asset is disposed of, the balance on its revaluation surplus account should be transferred to the retained earnings, but not through P&L. Therefore, the balance of 18 million for the asset that we disposed of shall be transferred to retained earnings. The accounting entries here shall be indicated. We shall debit revaluation surplus 18 million and credit retained earnings with 18 million. And the narration is to recognize transfer of revaluation surplus for asset disposed of. So that is as simple as that. Simple as that. Next, our transaction number 3. Remember, I'm still working on the additional information. I still have to exhaust the additional information before I go to the main computation. So the next one is additional information number 3. And here we are told that inventory at 30th of June 2015 was 1,250. 1,250. Now, of course, you all appreciate the fact that this has been given to help us determine the cost of sales. We may not have a major entry there. Additional information number 4 is about shares. And we are told that 100,000 shillings 1,000 ordinary shares were issued on 1st of January 2015 at a market value of 1,350. So here we are seeing the company raising more money by issuing more shares. This one is going to be explained with support of IAS 1. And this one I'm going to, of course, it's our transaction number 4. I'll bring out IAS 1, which is shares at market what? Shares at market value as discussed under IAS 1. The transaction is in regard to issue of 100,000, 1,000 ordinary shares. So ABC Limited shall need to recognize the cash that it has received from the issue of shares and the share premium for the amount issued above the book value. So the share capital shall be valued, or the component that is going to the share capital shall be valued in respect to the nominal value of the shares, which is 1,000. And then the issue was above 1,000, so it was 1,350. So the extra 350 must be taken to share premium because the nominal value of our shares is 1,000. The issue price was 1,350. So it means that the 350 is share premium. So in respect to this, we shall pass our journal entries by debiting the bank because all this money came to the bank, increasing our share capital by 100 million and increasing our share premium by 35 million. And this is to recognize funds collected from share issue and increase in equity. So that one will be as simple as that. And again, as you can see, we are continuing to work on the presentation of financial statements. At the same time, working out amounts in compliance with the relevant accounting standard. Next, I move to note number 5. Note number 5 talks about a current tax. And according to our note number 5, a current tax provision of 15 million is required for the period ended 30th of June, 2015. So current tax is basically IAS 12, National Accounting Standard 12, income taxes. And this is almost like a point of information that we should make a provision of 15 million. So no major adjustment there. We shall do it directly on the financial statements. I'll move to transaction number 6, which is our last one. And here we have property, which had been further revalued on 30th of June 2015 at 980 million, and no depreciation charge had been recognized for the year ended 30th of June. So indeed, this one will need some kind of adjustment and extra calculation. So what we are going to do is to pull out the required standard, and I know most of you know which standard I'm going to talk about here. Revaluation is handled under IAS 16, which is property, plant, and equipment. And according to our transaction number 6, we are looking at a further revaluation of property. And according to IAS 16, the requirement, since there is a further revaluation, we must determine whether we have a gain or loss on revaluation. The gain or loss on revaluation should be recognized. And you know how to calculate the gain on revaluation. We get the revalued amount minus the net book value. Revalued amount minus the net book value. So the revalued amount, according to the additional information, is 980. The net book value of the property is 900 million. So that gives us a difference of 80 million. And this is a gain on revaluation. So according to IAS 16, if we have any gain on revaluation, it should be recognized on the account of the asset, and also to increase our revaluation account, or revaluation surplus account, with the same amount. So we debit the property account with 80 million and credit the revaluation account with another 80 million. And this is to recognize a revaluation gain on our property. So here at this point, you know you have handled all the additional information. So after handling the entire additional information section of the question, it is now your time. It is now our time to prepare our full set of financial statements. Of course, we are going to prepare the financial statements following the formats that we discussed in our previous segment where we discussed IS1. So we shall begin with the statement of profit or loss. Okay. And I think I'll go through together with you the full set line by line. Incidentally, we are not required to prepare the statement of financial position, but no worries, shall be able to see how that is prepared in our next exam type question. So basically for the required, as you can see, we're to prepare the statement of profit or loss, and then the statement of changes in equity is definitely required. So after understanding our required properly, we now move straight to our statements. I'll be discussing the format. So we begin with the title. So I'll begin with the title. Remember, IS1 says that you should identify the financial statements by identifying the users of the financial statements. I mean, by identifying the entity. And then, of course, we would indicate the currency and the level of precision. So our company, in compliance with IS1, is Abc Ltd. Statement of profit or loss and other comprehensive income for the year ended 30th of June, 2015. Don't worry about the year, whichever year you're looking at, or whether you're in 2024, or 2025, or 2020 what. This is just an example to help you appreciate what IS1 requires us to do. So what I've done, I have identified the name of the company and then the period for which I am preparing the financial statements. Again, in compliance with the standard, I will indicate the currency and the level of precision. However, I'm not able to provide the 2014 comparatives because the standard requires us to give the comparatives, but I will not do that because this is an examination environment where it's not going to be possible. It's not even realistic. But according to this standard IS1, we are supposed to indicate the comparatives. So since we are doing P&L, we begin with the revenue, which we shall show in our note number 1. We have the cost of sales. Again, we shall show in our note number 1. Then we have the gross profit. Then we have the administrative costs. We have the distribution costs. We have the operating profit. We have the finance cost, profit before tax, bring in the income tax. Then we shall have our profit after tax. Now, as you can see, this is the information given in the trial balance. Remember, in our discussion, we mentioned that the statement of profit or loss can be prepared in 2 major ways. You can prepare expense by function or expense by nature. So, how do I know which format I'm going to use? Should I use expense by function? Should I use expense by nature? Definitely, the answer is within the trial balance. As you can see, expenses are given by what? This is by what? Anybody who can tell me? Distribution expenses, administration expenses. I think this is, I can talk about finance. This is expense by what? By function, by nature. Expense by function. Oh, now you're confusing me. Flora says function, Sarah says nature. Now, I don't know which one is which. Anybody? Anybody else? Should we go with Flora or Sarah? Should we go with Flora or Sarah? Okay. So we'll by saying we go with Flora. This is expense by function. So you'll be guided by the trial balance because you cannot have the two formats in one. It is either expenses by nature or expenses by function. So the answer is given by the trial balance. So we go back to our format, which is expense by function, administrative, distribution, finance. So what we need, as you can see, we need to determine our revenue because we have some adjustments. We need to determine our cost of sales because of the workings in the additional information here. So I come back here to my notes. Of course, I have another phase of my, I have another section of my workings, which I call the notes, and I have my note number 1 here. And in note number 1, I begin on the cost of sales. So here we are saying what is our opening stock. Opening stock is 1.1. We add the purchases, which purchases are 7235, giving us a total of 8335. Then we less the closing stock, which is 1250. Remember that, giving us our cost of sales, which is 785. Now, if this had been level 1 financial accounting, we would do this on the face of this statement. But because we are doing a statement following IAS 1, all that calculation is done in the notes. So don't do it on the face like the way we used to do it in financial accounting. That's not going to be accepted, and that will make you lose marks. Okay, I have, I think I have my sales. My sales are given outrightly as 10,235. If you can look at the revenue, 10,235, I don't think I need a note there. I don't need a note here on the revenue because the revenue has no adjustment. So that brings me to gross profit of 3,150. And then I have my administrative costs given in the trial balance as 820, 200. The distribution costs are given as 54,100, bringing me to an operating profit of 2.2. The finance cost has been worked out in note number 2. Let me see what we have here. So note number 2, we have our finance cost, which I work out. I'm not supposed to do it on the face. I have to do it in the notes. So the interest paid is given as 182,300. We also have an exchange loss of 55, which I bring to the finance costs because it is part of the loan, and the loan is part of the financing arrangement. So my finance costs come to 237,300, which I bring here in my P&L. I subtract from the operating profit, bring me to a profit before tax of 2,038,400. The income tax expense was given as 15 million, which I deduct from the profit before tax, bringing me to a profit after tax of 2,023,400, something like that, 23,400,000. Yeah. I still have the other comprehensive income because of the revaluation. We have a gain on property revaluation, which was given in the additional information of 80 million. And that brings us to total comprehensive income of 2,103,400. So as you can see, we have managed to prepare our statement of profit or loss, incorporating the additional information, incorporating adjustments, and of course, in compliance with IAS 1. We ensure that we follow in all aspects the format laid down under IAS 1. Please do not, I know you are innovative enough, you are very brilliant, you are everything, but please don't innovate in the exam. Follow the format. That's why we call them accounting standards, that they are standardized and you're not supposed to change them. If you want to change them, please go ahead and make your own standard and tell us this is a standard according to Sarah. This is a standard according to Agaba. This is the Flora's standard. So don't go against the standard that has been given. So with that, we have worked out the additional information. We have worked out the statement of P&L. And finally, we now work on changes in equity. We looked at the format of the statement of changes in equity. Again, we need to identify it with the title and the period that it covers. So I have ABC Limited, statement of changes in equity for the period ended 30th of June 2015. So as you know, I have all the columns here indicating the reserves under changes in equity, the share capital, share premium, revaluation reserve, revenue reserve, and the revaluation surplus. I begin with the opening balances for each of these accounts as given. There's no problem there. Then we have the issue of share that happened where we determined 100 million from the additional information for the share capital and 35 million for the share premium. We also have information that the dividend was paid, and remember from the provisions of IAS 1, we are not supposed to show the dividends under P&L. I hope that one was noted clearly. That one, we used to do it some long time ago, but according to the revised standard, dividends are no longer shown on P&L, but rather dividends must be shown in changes in equity. So a dividend is paid out of the revenue reserve, which is a dividend of 100 million was actually paid out in the period. Then the profit for the year will increase the revenue reserve, and that is the figure we got under P&L of 2,103,400. So that one is brought straight under the revenue reserve right there. Next is the revaluation that happened. We have indicated in the additional information that a revaluation was done, which led to an increase in the revaluation by 80 million. Then we are told that there was a transfer to retain earnings. Remember the other item that was disposed of. So we had to transfer the 8 million that was the revaluation surplus of that property from revaluation surplus and transferred to the revaluation reserve. At the end of the day, we have our balances carried forward on the statement of changes in equity as per our statement here. So congratulations, you have managed to go through your very first fully fledged exam type question on IAS 1. You still have 2 more numbers that we are going to do in the subsequent lectures we are going to have together. We still have our AUL, a more advanced, MUL, a more advanced question. This one is for Wednesday next week as we meet in the live class. Those who miss, I will record the lecture. You should be able to access that question on your student account. And then we have another one, which is another more advanced question, which is AUL. Again, this one is for Friday, and this should conclude our discussion on IAS 1. And from there, we shall be touching other areas which we feel relevant to position us better to tackle the forthcoming examination. I am sharing the workings. You should be able to download them from your student account.